Alright boys, special stream here for the BOE. Now, pretty important, the initial reaction that we're going to get here. Pretty important is also the size of the QE program. No QE program, I think we're going to 135. QE program that's substantial, then I say we might be going testing 132. Unexpected new measures, corporate bond buying, a few other things. Maybe we can get to 131, 130. The issue is not really about the first reaction down. The issue is really if the buyers are there waiting. All right, now we saw the buyers were waiting on Tuesday with the RBA. The US dollar is on the back foot, so it does make sense that any weakness here is going to be bought, and especially if you do get some positive stock market reaction as well, then it's not crazy to be looking to buy the pound here on the dip, right? It's in fact what I'm looking to do. All right, now I'm going to be very cautious though, and I'm going to check exactly what comes out, and we're about to find out that 50 billion QE is the standard. Anything more than that, you're going to get some heavy selling. Alright, straight up they're buying into the dip. So this is very bullish, guys. This is the sort of... So we're probably going to buy here a little bit of pound. Carney coming out in a sec. $60 billion, so a little bit higher than expected, but not really. There is a corporate bond buy pen. You can see the market doesn't want to sell just at the moment though. So I'm trying to buy this. The price action is very telling here. It could be 100 points, the easy 200 points low. So this is letting you know that the market is already short. This is not enough to get the selling. Now Carney's coming up in 30 minutes, so that's going to be key here to if we can get follow through. But the initial reaction is suggesting that we're going to go higher here. So I might hold off just a sec. One way to play it is selling euro pound, but yeah, sellers would be really disappointed with this price section. Let's bring up the FTSE, see how the FTSE is moving. In other news though, Aussie Kiwi's doing quite well. So let's help sentiment a little bit here in the trading room. Alright, not bad. Might buy a little bit of that as well. Top of my head, I'm not sure how much of that is. Let's see. So yeah, I'm buying into this dip. Look, it's dangerous. Of course, Carney can be ultra dovish, and that's going to be his job probably. But these measures were designed to try and stimulate the UK economy. The market's very forward-looking, and the positioning, most importantly, is very short for the pound already. So buying on this dip does make sense. Although the sell-off was pretty quiet, the rebound also has been pretty quiet. Interesting. Buying quarter lots here, so we're not buying full lots. Just looking for the sellers to lose control. A little bit of gradual selling coming through though. This breaks 132, it could get interesting. In reaction to the corporate buy ban, this is what's probably moving the market here. And that's what a lot of questions are going to be about. Whether we can go negative interest rates. The vote on the asset purchase program was pretty close, 6-3. The vote on the corporate bond purchases was 8-1. It was a unanimous 0.25 rate cut. So they didn't get the 0.5 rate cut that some people were looking for. Still, we got a chance to go down to that next month if it's needed. But relatively muted price action so far. This is pretty much as expected. The $10 billion price action corporate bond is a little bit extra on top. Oh, you can buy this, Potter. I think this is very muted selling, right? I don't think the market's moving aggressively at all just yet. He's pretty relentless selling though. I'll give you that. It's almost like there's a big boy sitting on that offer, right? Just bang, 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 bang. It could be eating up all us retail buyers. Let's see if we can get the link ready for the Carney. Alright, so the way I played it is I've gone long the UK stocks on that corporate bond program, and I bought the pound. So far the stock trade's doing better than the pound trade, that's for sure. A little bit linked, but let's just see what we play through now. And Magic's looking for a permanent ban. Alright. The selling is a bit relentless, but I'm not too afraid of the price action so far. Yeah, look, relatively aggressive. FTSE I think has a fair bit of upside here. So I don't mind remaining holding long. I don't mind holding both these trades. These are medium-term trades, not just straight up. So buying FTSE, buying pound. What I'll do is I'll get some immediate reaction from you guys, and also what we'll do is we'll set up the Carney speech. I'll be back in a couple of minutes. I might go over a full market update as well, just to let you know how everything else is progressing. But keep an eye on this pound for the short term. All right, boys. Look, this could have actually gone down a lot differently, uh, given that announcement. So that's the main reason I'm bullish. Don't think for a second that this is not dovish in terms of its initial release. The price action is what I'm bullish on. So that what actually could have happened here, we could have been at 130, 130.80, 130.50, even 130 on that same announcement. But the market positioning is so stretched, and people I think were starting to over expect as well. So there's expectations, and there's whisper numbers, and there's sort of positioning into the announcement. So positioning into the announcement is very key. And a lot of people are selling, and those sellers have to take profit. They're taking profit at the moment, becoming a bit more neutral. Then it's like back to, well, what are we going to do here? Sell the pound for below 130, or is the US dollar weakness too strong and going to overtake this to the top side? All right, so I'm in the latter camp. I think that the US dollar weakness is going to be too strong, and that those who are selling are going to be disappointed, and then they get out quicker than the longs. Carney's definitely a wild card, though, right? Carney's got one mission today. Carney's mission is to wreck the pound. So that's sort of against the trade idea, but he's a pretty calm, cool, collected guy, right? He's not. I don't think he's made the same stuff as Kuroda and Bernanke and Draghi. I don't think he's prone to sensationalism, so I don't think that there will be spooking of the pound to the low side. For this video. So the Carney speech is in 15 minutes, guys. He's going to attempt to talk it lower for sure. FTSE's doing quite nicely here. So I'm long FTSE, long pound. A little bit hedge counter trades, but yeah, we'll see how that plays out. I mean, if I'm playing safe, I probably should close everything right now. Which, given that I'm trying to cheat safe trading, I might end up doing. Alright, well, what we're going to do is close out the FTSE and close out one of the pounds for loss. Just leave a little bit of pound long. Okay. The trade that we have at the moment is long Aussie Kiwi, long Euro Swiss, and long Euro Yen. Look, I mean, trading news announcements is possible. It is probably the least consistent form of trading you can do, though. I mean, you quickly have to analyze what has come out and what the market's doing and which has got potential to move more. And that, I mean, you're competing against computers. Yeah, it's very hard. It's much easier to let the market settle down than trade according to tech levels, but you can read into the price action a little bit, then read into the positioning, and then add a little bit of fundamentals on top, so you can get that edge back. Straight after announcements is pretty wild, especially a big announcement like this. So far, though, the reaction has been muted. This is still. If you told me that they were going to do what they did, and the market only fell to 131.80, I'd be like, oh, okay, we're buying that. I'm just reading through the statement, guys. So you're asking why is the Kiwi and the Aussie rallying on this data? It's because stocks are quite strong. Yeah, stocks are quite strong, so you're getting some squeezing coming through on the yen crosses. Because dollar yen's trying to pop higher with those stocks as well. So let's have a little look at that, what we're talking about there. So let's say you want to know why Aussie's rallying, or the Kiwi's rallying. The Kiwi's popping here, but most of that buying is coming through on the Kiwi yen. Alright, so when stocks rally, you do get that little pop higher. Yeah, and that's just normal. So it's not really directly related to the announcement, it's related to the stock market reaction to the announcement. And you can sort of see that with the reaction of the euro. Euro down a little bit in sympathy, but also down a little bit because that dollar yen buying. So of course, very interesting here will be pound yen's reaction. That's the most aggressive way of getting involved here. So we'll look at that later as well, but just straight for now, we're going to stay tuned in on the pound. Trying to get the link for the BOE press conference. It doesn't seem like it's out just yet. The boy's still forming that. So they've given indication they're going to cut again. That helps a little bit more of the negativity. So just looking through some of those initial reactions here from some of the traders I follow on Twitter. Some other side note here, the forecasts from the BOE aren't as aggressively negative as some of the ones on the street. So 2017 isn't expected to be a recession. So FTSE's taking another leg higher. So press conference should be beginning here, guys. I haven't found the link yet. If anyone's found that link, I would really appreciate that. Tony is on the gin. What how'd you know, mate? Yeah, nah. It's 9:30 here in Sydney. Have one or two. Don't drink much anymore. Well, maybe I was a little aggressive buying such a big announcement, as in such an overkill announcement, but I think what there has been is a very little snapback here. That's concerning me here. I might close out the other little one I made. I mean, Carney is going to try and talk it down. Make no mistake. So if he talks it down another 100 points, you can just buy low, right? Very little bounce back. That being said, the ability for them to do a lot more is limited now as well. If they slow played it, they could have kept the market on edge in coming months. So in coming months, what are they going to say? We're going to expand the QE program that hasn't even started yet. We're going to go negative rates. We're going to have to talk about negative rates, really. That's the only thing they've got left. But the UK bond yields are getting smashed. So that does sort of pull support away from the pound. So it is potential. We've got that next leg lower here. But it's what happens next after that. How sustainable is the sell-off? That's what we're really trying to position for. Haven't got a real trade on yet anyway, just a quarter one. 132.40 left. But yeah, if you're looking for a way to play it long footsie, this is all long footsie stuff. You got the conference started. Where's it? You got a bloody link there, mate? All right, excellent. Thank you, FXWW.
uncertainty. And that's why, at its meeting yesterday, the MPC agreed an exceptional package of measures comprising, first, a 25 basis point reduction in bank rate to 0.25%, a new term funding scheme to reinforce the pass-through of that cut in bank rate to the borrowing rates actually faced by households and businesses, a new program of private sector asset purchases with up to £10 billion of UK corporate bonds, and a £60 billion expansion of gilt purchases. We took these steps because the economic outlook has changed markedly, with the largest revision to our GDP forecast since the MPC was formed almost 2 decades ago. Early indicators are consistent with the risks that the MPC had identified before the vote. And we now face a trade-off between the degree of support we give to the economy on the one hand and how fast we return inflation sustainably to target on the other. By acting early and comprehensively, the MPC can reduce uncertainty, bolster confidence, blunt the slowdown, and support the necessary adjustments in the UK economy. The degree and composition of that stimulus is largely determined by the effects of the vote to leave the EU on demand, supply, and the exchange rate. So beginning with demand, the 9% depreciation of sterling since the referendum will boost exports and weigh on imports. However, even though the MPC expects the current account deficit to halve over the next 3 years, improvements in the external sector are not expected to offset fully the drag from substantially weaker private domestic demand. The MPC expects several factors to weigh on investment in the near term and on employment and consumer spending over time. These include a protracted period of heightened uncertainty, weaker activity in residential and commercial real estate, and a higher cost of capital for UK-focused firms. Some of these effects are beginning to manifest in surveys of investment intentions, business activity, and the housing market. These indicators have all fallen sharply, in most cases to levels last seen in the wake of the financial crisis, and in some cases to all-time lows. The MPC has been conservative in its interpretation of these data, producing a forecast stronger than historical relationships would have implied. Nonetheless, we expect aggregate demand to grow only a little over the next few quarters before picking up to rates below those projected in May. The extent to which this lower path for aggregate demand is likely to be accompanied by a lower path for aggregate supply is a key determinant of the inflation outlook. The weakness in demand will itself weigh on supply as a period of low investment restrains growth in the capital stock and productivity. There could also be more direct implications for supply from the decision to leave the EU. The UK's trading relationships are likely to change, but precisely how will be unclear for some time. If companies are uncertain about the future impact of this on their businesses, they could delay decisions about building capacity or entering new markets. In addition, in anticipation of the UK's new trading arrangements, a period of resource reallocation could be necessary as some sectors of the economy expand and others contract. As a result of these factors, the MPC expects supply growth to remain well below past average rates throughout the forecast period. The combination of these demand and supply factors means that cumulative GDP growth is expected to be 2.5% lower by the end of the forecast period than was the case in May. On balance, even after stimulus, a margin of spare capacity is expected to open up and the unemployment rate expected to rise from its current level of 4.9% to around 5.5% over the next 2 years. The fall in sterling will push up on import price and consumer prices, notably over the next 3 years. Indeed, despite the much weaker outlook for activity, CPI inflation in 2 years' time is projected to be higher than expected in May, reaching 2.4% at both the 2- and 3-year points of our forecast. The MPC's remit recognizes that when the effects of shocks persist over an extended period, the MPC is likely to face an exceptional trade-off between returning inflation to target promptly and stabilizing output. When this is the case, the remit requires the MPC to explain how it has balanced that trade-off, including the horizon over which it aims to return inflation to target. Fully offsetting the persistent effects of sterling's depreciation on inflation would require exerting further downward pressure on domestic costs. And that would mean even more lost output and a total disregard for unemployment. In the committee's judgment, such outcomes would be undesirable in themselves, and moreover, they would be unlikely to generate a sustainable return of inflation to target beyond its 3-year forecast horizon. As a result, some of the adverse effects of the shock on growth, setting policies so that it sells a longer period than an usual 18 to 24 months horizon. To achieve this balance, the MPC is today implementing a timely, coherent, and comprehensive package of measures. First, the response is timely because the combination of a markedly weaker outlook for the economy and the lags in the transmission of monetary policy dictates the need for stimulus now. For example, cutting bank rate will immediately ease financing conditions for households and firms. Around half of mortgages are floating rate, as are more than 4/5 of bank loans held by firms.
You can guess
Lower
what my those are little buy orders in M24
in this
were,
economy.
right?
Second, the package of measures
Guess
is
what I
coherent.
bought the pound against there. That's the
MPC
test.
recognizes
That's the test.
that when interest rates are very low, bank rate cuts might not be fully passed on to the interest rates actually faced by households and firms. Indeed, there have been examples overseas of interest rates on loans increasing when official policy rates have been reduced from very low levels. The MPC is determined that the stimulus the economy needs does not get diluted as it passes through
It's got
the
enough
financial system.
bandwidth to do everything.
That's why it is
I'm not
launched a
downloading
new
anything, man.
term funding scheme. The TFS will reinforce the transmission of cuts in bank rate to the interest rates actually faced by households and firms. Compared to the old funding for lending scheme, the new TFS is a pure monetary policy instrument that's likely to be more stimulative pound for pound. Specifically, it reinforces those bank rate cuts. Secondly, it reduces the effective lower bound for bank rate to close to, but a little above, 0. Thirdly, it charges a penalty rate if banks don't lend. It covers all types of lending, and it's funded by central bank reserves. UK banks and building societies could borrow up to 100 billion sterling over the next year at rates that neutralize the effects that could otherwise cause them not to pass on the new lower bank rate to end borrowers. The coherence of today's package is further enhanced by the FPC's decision today to amend the leverage ratio framework for UK banks by excluding central bank reserves. Effectively, this gets a regulatory constraint out of the way of monetary policy operations without compromising financial stability. It's enhanced by the FPC's earlier action to increase the availability of credit by £150 billion by cutting the counter-cyclical capital buffer to 0 and emphasizing the bank's liquidity reserves are usable. And it's enhanced by the PRA board's decision to use regulatory flexibilities to smooth insurers' transitions to new regulatory standards in a very low interest rate environment. And third, this package is comprehensive. The cut in bank rate, the new TFS.
What we're looking for here is the Q&A session, not so much his statement.
In the absence of these actions, output would have been lower, unemployment higher, and slack greater over the forecast period, and the return of inflation to target would have been less sustainable. The purchase of up to 10 billion of UK corporate bonds will support the real economy by directly affecting the financing conditions for companies that make material contributions to UK economic activity. By supporting investment, this action should improve the monetary policy trade-off with inflation. By acting in capital markets, it will be complementary to the TFS, which reinforces the bank lending channel. And by lowering credit and liquidity premia, corporate bond purchases are an efficient means of providing stimulus. Expanding the stock of gilts held in the asset purchase facility by £60 billion will reinforce the transmission of lower bank rate to longer-term market interest rates. In addition, by triggering a process of portfolio rebalancing amongst sellers of long-dated gilts. Gilt purchases will transmit to other risky asset prices, easing financing conditions and providing additional stimulus directly. In conclusion, the MPC has worked with the bank's other committees to understand how conventional and unconventional monetary measures interact with the financial system. We've tailored our approach to avoid unintended consequences. This joined-up approach using multiple channels will ensure that stimulus will have maximum impact on the real economy. By acting now, the MPC is supporting the necessary adjustment of the UK economy and ensuring a more sustainable return of inflation to target in the medium term. This timely, coherent, and comprehensive package of measures is appropriately sized given the scale of the shock, uncertainties about the degree of adjustment, and the relatively limited data. All of the elements in this package have scope to be increased. The MPC can lower bank rate, increase the size of the TFS, and expand the scale or variety of assets held in the asset purchase facility. Indeed, if the incoming data prove broadly consistent with the August inflation report forecast, a majority of MPC members would anticipate a further cut in bank rate to its effective lower bound at one of the MPC's forthcoming meetings during the course of this year. Today's announcement is the latest element of the bank's joined-up policy response to the referendum, a plan that was based on months of extensive analysis of the risks, detailed planning, and appropriate public communications. A plan that delivered a broad range of contingency measures to contain the immediate impact on the financial system of the result of the referendum. A plan that's already expanded the amount of credit available to the real economy. And now a plan that delivers a timely, coherent, and comprehensive monetary policy response that lowers the cost of credit and improves financial conditions for households and businesses across a wide range of channels. The Bank of England continues to stand ready to take whatever action is needed to achieve its objectives for monetary and financial stability as the UK adjusts to new realities and moves forward to seize new opportunities outside the European Union. And with that, we'd be happy to take your questions.
So, excuse me, as always, could you please give your name, the organisation you represent, and for the first go-round, stick to one question first, please. Emily first.
Emily Cadman, Financial Times. Governor, you've been clear that monetary policy can only mitigate but not cushion entirely the shock of Brexit. Is there anything the government can and should do?
Well, the first thing, Emily, is that obviously we can act quickly, and I think the bank has acted quickly across from contingency planning, the actions of the FBC, and now the actions of the MPC. So monetary policy is more nimble, and it's appropriate that it's the first responder to a shock. Clearly, the biggest elements of the change are structural, and monetary policy has to take those structural changes into account in setting policy, but it can't really do anything about those structural factors. So the biggest issues for government are those that they've acknowledged, which is the importance of the negotiations with European allies on the new relationship that will be developed, the importance of having a productivity plan, comprehensive productivity plan for the country. And it's within that context, or it's those decisions and those policies which will really be the determinants of the long-term prosperity. What we need to do in that context and in advance of those decisions is to provide the appropriate stance of monetary policy to ease the adjustment. We're governed by a remit, and in that remit we are governed by a trade-off and setting the right trade-off between getting inflation back sustainably to target and supporting output. And we, I think, have pretty clearly outlined in the report and with this decision how we see that trade-off and where we can provide support. Thank you.
And then Kamal.
Ed Conway from Sky News. Governor, you, in the inflation reports, do not see the UK having a recession. Is that as a result of the action the bank has taken? Were it not for what the bank has decided today, would the UK have faced that recession a lot of people were concerned about in the run-up to Brexit?
Yeah, well, I think first is to reemphasize how you started the question, which is our central forecast is for a relatively modest or period of growth initially second half of this year. We describe it as there will be little growth in the second half, but positive growth in the second half. That's our central expectation. And then the growth would pick up over the forecast horizon, aided by monetary policy, importantly, as the transmission starts to come through. Growth would pick up but to levels below that expected in May. So that's our central expectation. If we hadn't taken the steps we took today, we do expect output would have been lower, unemployment would have been higher, and we would have achieved a poorer balance in terms of returning inflation sustainably to target and foregoing output. Now, with all forecasts, there are risks on either side. It's possible that growth could be a little stronger. It's possible growth could be a little weaker. We have, in the actions that we've taken today, by acting through multiple channels with a coherent policy package, we have improved the economic outcomes for this country. There will be less unemployment, there will be more activity, and there will be a greater prospect of a successful adjustment to the new realities that the UK faces.
Kamal Ahmed from the BBC. Governor, given that the supply of finance possibly isn't the most serious issue facing the UK economy, how can you be sure that any of the measures that you have announced today will work and not just simply very marginal attempts at mitigating some of the effects of Brexit? And also just wondered, what's your message to savers who must be looking at the announcement today and thinking there is no point in me saving money for the future?
Okay. Well, the first thing is that we're living through a time of considerable uncertainty. And one thing we can do is reduce the uncertainties over the issues we have control. We have tremendous influence over the supply of finance, the price of finance in this economy. So the actions of the FPC a few weeks ago on the countercyclical buffer that built on years of building up the capital position of the banks have been absolutely reinforced by the actions of the MPC today to improve the price of credit, overall financial conditions. And I want to stress this point, which is that the MPC didn't just pick certain stimulus measures. It sat down, it thought through, had very detailed analysis, extensive conversations with the FPC, with the PRA board, to think through how various stimulus options would interact with not just the banks, but the financial system as a whole, and design the program in order to determine that we would get the maximum amount of stimulus to households and businesses.
Important little attempt to bounce here, guys.
And
I mean, a lot of people have been selling that.
It's an important aside.
On the back of this speech, right? He hasn't really provided too much punchy negativity. Hasn't talked about negative rates yet.
If you qualify for a mortgage, you should be able to get access to credit. This is not 2008, 9, 10, 11, 12, 13, and half of 14. Okay? It's a different world. But that's enough in people's memories that it's important to take that off the table. Secondly, the stimulus measures we're taking are going to flow through. They're designed to flow through, and we've thought it through in terms of how, and we will be watching that they flow through. That has an effect. As with all monetary policy measures, it builds. It's an effect that builds over time. There's an immediate cash flow effect that people see, but it will build over time and have an impact over the forecast. Let me turn to your second. So we can control what we can control no more, and we're not going to ignore or step aside on those issues when it's our responsibility. With respect to savers, let me first say this is something that we think about a lot. There's a group of people who have worked hard, absolutely done the right thing, set money aside, and the returns are very low, and they're likely to be low for some time. That's true in the UK. It's true in all advanced economies. And the challenge is to get the economy in a position so it can grow sustainably at a higher rate. Those decisions will be determined not by the Monetary Policy Committee, but to go to Emily's question earlier, those are the big structural decisions that will be made by governments. We can support that adjustment, and we will ensure for savers, for pension funds, for insurance companies, for other pools of capital that ultimately are only there for the benefit of UK citizens, but for all those entities, that there will be a better economic outcome, that the economy will grow more, that there'll be fewer unemployed, and that ultimately we'll adjust to this new equilibrium faster and in a better way. And that's our contribution.
News. Governor, last week NatWest and RBS talked about their concerns about negative interest rates. This is something that you yourself have expressed many concerns about in the past. Can we now definitively rule out the possibility of negative interest rates? Because I note that in the report you say that
this is a very important question.
To the lowest
very
level
important
of interest
question.
rates being just above
All
zero.
right. So the
But we
reaction
noted
here
the
to the
use of
market and
word
what he says.
currently.
Okay.
Yeah. Thank you for the question. Look, as you might have gathered, and you said in your question, I'm not a fan of negative interest rates. We see the negative consequences of them through the financial system. We've seen that in other jurisdictions. We see the issues with savers. It goes even further than the issues that were just raised with Kamal. We have other options to provide stimulus if more stimulus were needed, so we don't need to go to that resort. I think the MPC is very clear that we see the effective lower bound as a positive number, close to zero, but a positive number. And we will continue to be clear in our expectations.
All right, that's
that.
very that's
let me say
supportive of
this
the
about
pound
the
guys.
The banks have no excuse with today's announcement not to pass on this cut in bank rate. And they should write to their customers and make that point.
Phil Aldrich at The Times. Governor, I'll pick you up on that last point then. The banks have no excuse not to pass this on. It looks like potentially a £750 million bung that you're giving to the banks through the term lending scheme. This is through reducing their funding costs against that 1%, which you said is the average norm at the moment. Is it possible that you should, or are you considering wrapping this with a condition that around bonuses, with any conditions around dividends, to make sure that there is a sort of responsible approach here?
Well, I'd say a couple things. There's two sides to this. One is that what we have seen elsewhere and what we see here as their supervisor is the squeeze that starts to come in on bank margins that then affects the price they charge on marginal loans. This is really about the new loans that they're making, the price they charge on new loans. That happens when interest rates get very low, very close to zero.
He should have answered that question differently, guys. That was a swing and a miss by Carney.
Number of years. We have very carefully calibrated the pricing and the sizing of the TFS.
If you put a floor underneath the negative, the total negative amount that can go, that's when markets start to forward look. So they look to the US dollar side here. But we'll see if that comes through in analyst reports tomorrow. But I'm pretty sure that will. It's pretty important what he just said then.
That ensures that they can fully pass through the cut in bank rate. And by the way, it's fully pass through the cut in bank rate to their customers. By the way, it's a facility that also means that we have some limited but additional flexibility to lower bank rate if that's required to support the economy. Again, in a way that further reduction would be passed through. So it's offsetting a squeeze that could be there, and it's an advantage of the structure of this institution, candidly, and the MPC listening to other parts of the institution, asking the questions and then listening to other parts of the institution, in that we're able to understand these dynamics and design a facility that does that. There are penalties, penalty rates if banks reduce lending, but I would stress this is really about, and your question is about, the transmission of those bank rate cuts to the real economy, as opposed to a scheme to incentivize certain amounts of lending. That was the old FLS. This is designed for a different purpose.
Larry Elliott of The Guardian. In his letter to you today, the Chancellor said he was prepared to take any necessary steps himself to boost the economy over the coming months. If he was to issue infrastructure bonds for public investment, would you have any objection to using the asset purchase facility to buy those bonds?
Well, the first thing I'll say is that, as you'd expect, since the Chancellor was appointed, he and I have met a number of times to discuss the economic situation, to discuss policy options. As you would expect, as you know, the Chancellor himself, or whoever the Chancellor is, he or she is, knows the broad outlines of an MPC decision prior to that decision. And of course, in the case of this decision, where there's an indemnity being given for the asset purchase facility, we had extensive discussions of the possible decisions of the MPC. So we're fully aligned in terms of, or he's fully informed in terms of the MPC's thinking and the broader bank's thinking about what we can do to support this adjustment process. As you rightly note, he has been clear that he's willing to take any necessary steps to support the economy and reduce uncertainty. Those are the decisions for him and for the government, and they operate on a different time frame. With respect to, and we're not privy to those decisions, and as you can see in the forecast, we make no assumption about any change in the stance of fiscal policy, for example, in the forecast, this is as per convention, as we always do. We think, the MPC thinks this is the right package for today, so it's not appropriate for me to commit that we would countenance doing something else beyond what we have said. And the one thing we have said is that for a majority of members of the MPC, if the data over the course of this year comes in broadly consistent with the forecast in this inflation report, they would expect to move bank rate to that effective lower bound just above 0.
Thank you.
And then, David after.
Thanks. Andy Bell, 5 News. Governor, just to go back to the source of all this, drawing on all your experience, just how extraordinary was the problem with which you were presented by the Brexit vote?
Well, it's an unusual situation in the sense of it is a very large identifiable supply shock. You know, the biggest news on the horizon is there'll be an adjustment to the supply potential of the economy. I would distinguish that there's an adjustment with the changed relationship with the EU, and then there's an adjustment which may happen at the same time or maybe slightly after with expanded relationships with the rest of the world. So we have to think about that supply shock and how that affects the economy today. That's a relatively unusual situation. What isn't necessarily unusual is to be in a position where there is a trade-off between supporting activity and the time horizon over which a monetary policy committee returns inflation to target. And one of the advantages of this system, having been operating on another system, one of the advantages of the system here is that we have to be very upfront and transparent about how we thought about that, which disciplines the committee, and we come out and are clear over what horizon we're going to bring inflation back and how we're going to support the economy. So that unusual is the supply shock. The trade-off isn't that unusual. The third aspect, which is somewhat unusual or exceptional, to use the language I've used today, is the fact that given interest rates are relatively low, and given what we now know about the interaction of conventional and unconventional policy with the financial system, it has been relatively unusual or it has required some creativity or innovation in terms of the design of the package in order to get the right amount of stimulus in a way that will really affect underlying financial conditions.
David Smith, Sunday Times. Governor, one of the responses you may get to this from people who supported Brexit, and maybe even from some former MPC members, is that this was an overreaction, or is an overreaction, based on fairly limited evidence, and that it could even undermine rather than boost confidence because of the scale of the bank's actions. How do you respond to that?
Well, look, this is the appropriate response to the economic conditions in which we find ourselves. This is a response which will make this process of negotiation, transition, ultimately Brexit, it's going to support it. It's going to make it more likely to be a success, not just in the longer term, but in the nearer term. It's going to help with adjustment. There is a great degree of uncertainty. It's entirely understandable that there is. There's uncertainty about the eventual model that we will have with the European Union. There are a number of options on the table. Whichever model is chosen itself will require some degree of adjustment in the economy, and that brings its own effects on growth and productivity for a period of time. We are seeing, and I'm going to ask Ben Broadbent to expand on this, we are seeing these risks manifest in a wide variety of indicators which actually in many cases are better indicators of what's actually happening in the economy than hard data, so-called hard data. And there is a clear case for stimulus, and stimulus now, in order to be there when the economy really needs it, to have an effect when the economy really needs it. So this is about cushioning the shock, supporting the adjustment, taking uncertainty off the table, and ultimately making this a success. But I might ask Ben to speak a bit to some of the data to go into it.
Yeah. Perhaps I can say to start with that there are sort of, in the information we get, degrees of hardness, if you like. Even the early official estimates of GDP I wouldn't describe as totally hard, in the sense that they get revised for many years afterwards. And many of these surveys continue to have information about what that final estimate of GDP will be many years from now, even after the ONS has started publishing its own earlier estimates. If you look at the chart on page 22, the top of that page, this is one of the more reliable indicators of activity, the SIP surveys. We've weighted the sectors here into one single series, or rather two, one for output, one for expectations. These are the steepest falls in both those series we've ever had. And they are both of them at levels we haven't seen since early 2009. They are reliable indicators, these and a few other surveys, and I would point out that if you took them at face value, they would suggest the economy is actually contracting. Now, we've aimed off that. We've aimed off it precisely because on occasion, even for these surveys, big shocks can lead to overreactions of things like this, and in particular the other confidence indicators. But we would need them to recover in coming months to meet the forecast we have, which is for a little bit of growth during the second half of the year. So I don't think it's premature to have acted in the face of weakening in these output surveys, weakening employment surveys, steep falls in some of the investment intentions against a backdrop in which investment was already falling, and also pretty steep falls in indicators of housing market activity.
Yeah, Louise Cooper, freelance. On Radio 2 yesterday, and a saver, a lady, doing a question and answer session actually for ordinary people, what this meant for them. And a lady, I think she was called Lucy, called in and she said, I've got £6,000 of savings. What do I do with them? What do your models assume she does with them? Do you assume that savers spend their money? Do you assume they're forced into riskier assets? What do you want them to do with their savings, which, if your inflation forecasts are right, are earning substantially less than inflation over the coming years, and their purchasing power is going down?
Yeah. Well, the first thing is our models and the way we look at the economy is we look at it in aggregate. Because that's our responsibility, is to target aggregates, aggregate level of inflation, keep it low, stable, predictable, that 2%. That's the core of our responsibilities. But in doing that, to do it in a way that minimizes impacts on output, how much activity in the economy, and employment. And we're faced right now with a forecast after a substantial stimulus package where the unemployment rate goes from 4.9 to 5.5%. It's more than 250,000 people losing their job after stimulus. Okay? Should we ignore that? Should we have more? I'll get to the point, but should we have more people lose their job in order to target a different part of the economy? Should we have a poorer outcome for the economy at a time when there's great uncertainty? Should we change the way we manage our responsibilities to aim off what we are statutorily obligated to do, which is to manage this trade-off to achieve the inflation target over the medium term? That's not the judgment of the MPC. Every single member of the MPC's view was that this economy needed stimulus now. Different views on different degrees of stimulus and packages, but everyone viewed that needed stimulus now. I fully recognize, we fully recognize, that a long period of low interest rates puts savers in a very difficult position, and fully recognize that there's a difference between individual savers and institutional savers, the pension funds, the UCITS, the insurance companies. We do expect those aggregates, and what we do see for those bigger institutional savers are the moves into riskier assets, longer dated government debt, into corporate debt if they had government debt, into equities if they had corporate debt, from equities into hard assets if they had equities, and on and on. And that supports the economy. That makes it less likely that we will have a very long period of high unemployment, low output, and very low interest rates. But I'll say one last, so we recognize the challenge. Ultimately, this lessens the challenge for the economy as a whole. I'll say one last thing, which is that when you step back, as we must, and look at the global economy as a whole, and what's happening to interest rates in global economy as a whole, there are a variety of forces. Some of it's the legacy still of the financial crisis. Some of it is broader demographic forces. Some of it's the rise of China and other economies. Variety of factors which are all pushing down on global interest rates globally. And we're faced with the choice that as that, and I'm sorry to use jargon, but as that equilibrium interest rate goes down, and in fact in many jurisdictions goes negative, we're faced with a choice of either ignoring it and then running monetary policy too tight and unnecessarily contracting the economy, unnecessarily missing our mandate, or adjusting with as smart stimulus as possible, that is as effective as possible, goes through multiple channels, which doesn't just go through the channel that directly affects the saver, but goes through multiple channels, which doesn't lead to negative interest rates, to go to Narina's question, in a way that that can support growth. And that's the judgment that we've been that we have made today.
Hugo and then Harry.
Thank you, Governor. I note that you discussed cutting rates immediately to the effective lower bound, and a majority thought that that was could be done now. You didn't in the end. Is that because you wanted a unanimous decision on rates? I note that the decision to buy government gilts was not unanimous because there was concerns among 3 members that recent surveys overstate the weakness of the economy. Were you trying to give a unified decision on interest rates at least, hence the reason why there was just the quarter-point cut?
Well, there are 2 reasons. First is that we were able to provide the stimulus in other ways, and we saw value in having a package of measures as opposed to relying on one measure alone. Why is that the case? First, it goes through multiple channels: bank rate at the short end, gilt purchases long end, corporate bonds, through a new channel, and then the TFS making sure those bank rate cuts get across. So multiple channels, complementary, mutually reinforcing, stronger as a result. And by the way, all of this backed up by some other technical decisions of the FBC around the leverage ratio and countercyclical capital buffer, important technical decisions. So value in having a package, and also the reality that we will have another meeting in September, another one in October, another one in December, and we will get more data. As we said, if the data is broadly consistent with the forecast, a majority of members would expect to act during the course of this year. I would stress that on all elements of this package, we have scope to add if that were necessary. We would do so, but only to the extent that it's consistent with our remit. So it is very much contingent on how the forecast evolves.
So Harry first, and then
Hi, Governor. Harry Daniels, Live Squawk News. Listening to your response about other central banks and the actions they've taken, having looked at other central bank decisions, did that affect the MPC's decision to deliver a bigger package now, as opposed to wait and see where the data went? And also, is there a yield limit at which government and corporate bond buying will be capped, as in the ECB, and the way they work their bond buying scheme?
Well, the answer to the second is no, and the answer to the first effectively is no as well. We're influenced by conditions here. This is a package which targets the domestic economy. That's where the big adjustments are going to take place. We've already had a notable exchange rate adjustment, which will help the external sector. We do see the external sector as importantly contributing to growth. We do see the current account deficit likely halving over the course of the forecast horizon. But it's the domestic economy which will need some support from monetary policy, and that's why we designed the package as we did.
Sue.
Hi, Sue Chan at The Telegraph. Just a follow-up question on the term funding scheme. On the one hand, you say this scheme was specifically designed to help banks with their net interest margins to ensure that all the benefits are passed on to households and businesses, and there should be no excuses. On the other hand, we've already seen lenders increase their tracker margins on mortgages. So what conversations or reassurances, if any, have you had from the big lenders that the benefits will be passed on to borrowers as well as the potential cost to savers?
Well, one of the things, Sue, we did not discuss any monetary policy measures we were considering taking with anyone in the financial system in advance, as you would expect.
They voiced it, through the media about.
Well, I think the concern voiced, as I interpreted it, was concern about negative interest rates, and we're not intending to move to negative interest rates. I'm not intending to move to negative interest rates. There are legitimate concerns about this compression. We've seen it in other jurisdictions. We understand the dynamics of it. Effectively, you understand the point, but it's hard to see deposit rates, and one wouldn't want to see deposit rates go below zero. So there is value to having some offset, and we have very good line of sight into what that offset should be, and that's how we've designed it. I'll say one thing, which is
we've after he said that he's not a fan of negative interest rates, I think that's one of the takeaways is going to be focused on going forward, and so the downside is a little bit more limited. So that's one of the main reasons. I'll look at. You don't really want to be aggressive here, so trade smaller than usual. 132 is the target for me. You do have non-farms tomorrow. That's really going to break or make the whole US dollar rally. But yeah, this sell-off this was a pretty aggressive action by the BOE, and the sell-off has been very limited. So I think it supports the view that the cable shorts are stretched, and that more short covering will come.
Chief and the Independent. Governor, during the referendum campaign, you warned that a technical recession was a possibility as a result of a Brexit vote. Your pro-Brexit critics said that was inappropriate because they said it assumed no countervailing stimulus from the Bank of England. Now, today's forecast, they don't have a recession forecast in them, but the strong implication is that's because you've stimulated. So the question is, do these forecasts vindicate you or them?
Well, Ben, you're a sophisticated reader, as everyone is here, obviously, but a sophisticated reader of inflation reports. And you know that on the GDP forecast, we have a fan chart, which there are probabilities around. I'm quoting you the central expectation, the most likely outcome. We expect a little growth in the second half of this year, gradually picking up to relatively low rates over the forecast horizon, a cumulative 2.5% reduction in the overall level of GDP relative to what we thought in May. Now, that growth could be a little higher or it could be a little lower. I'll let you get out the ruler and figure out the probability that it goes below zero. And that's a forecast with stimulus. And so you can, if you can follow the logic, you can make your own conclusion.
Hi, William James from Reuters. You talked about monitoring the flow-through of this stimulus. Yeah. You mentioned it several times. I wonder if you could give us more details of exactly how you will monitor that, what criteria you use, and what levels will be acceptable.
Yeah, well, we look at overall. I mean, we supervise the banks themselves and banks building societies on an individual basis. We have virtually, if we want, real-time knowledge of where their net interest margins are going, where their profitability is going, and we're able to assess that both on an institutional, but what we're really interested in is on an economy-wide basis, so the sector as a whole. So we'll be watching that. Now, the net interest margins of the banks will be affected by a few factors. One is the pricing of this and the existence of this facility. The other is actually the economic implications of the package as a whole for the performance of the economy, the degree of impairments of loans which flow through. So we will look at that. We're not going to act as a shadow FCA on this. We'll look at the aggregate effects. The economics are there. It's there for a reason. It's there because there is an issue. To be absolutely clear, it's there because there is an issue. The banks aren't making this up, but it's priced in a way that neutralizes it, so that it can be passed on. And we do have competition in the banking building society sector, and we would expect to see that move forward.
Jeff Cutmore, CNBC. Governor, there's clearly been a reaction in sterling today to the announcement, but given the announcement as it stands and the package of measures you've taken, the bank is quite relaxed about the inflationary implications of that decline in the pound that's happened so far. But can I ask you, is there a size of decline or a proportion of decline in future for sterling that would raise alarm bells for you, or perhaps a type of market behaviour that the pound is experiencing that would raise concerns?
Well, we're an inflation targeter, not an exchange rate targeter. So having a flexible exchange rate is an important element of the monetary policy framework. Is an important element of the overall policy framework in this country. It's served the country well, and it helps with adjustment. But the stimulus that we've designed has been targeted not at the exchange rate, but at the domestic economy, in order to support the domestic economy. And we would expect to see it flow mainly through that. That's the first point. The second point is we have spent a lot of time.
That was another hawkish comment, guys.
Analyzing it.
Saying that this was not targeting the exchange rate.
We've learned since the financial crisis has been that pass-through tends to be protracted. It takes place over a number of years. And in fact, it's that which creates the sharpest bit of the trade-off over the forecast horizon. The reason inflation is at 2.4%, not below 2 in year 3, is entirely, in our view, because of the pass-through of past depreciation of sterling. So we're making a judgment about about looking through that so that we're sustainably returning to target. Now, there's a limit to which we would do that. We didn't reach, obviously we calibrated this package appropriately in the judgment of the MPC to balance that trade-off, but it shows that the existence of that shows that there are limits to where we would go in providing additional stimulus domestically. That sounds like a follow-up question there, Jeff.
We have loads more who haven't asked a question yet, I'm afraid.
Catherine Boyle from CNBC. So you've mentioned that in the report a potential decline in house prices over next year. Can you quantify that any further for us? And will there start to be any scenario where you could see yourself starting to have conversations about negative rates ever?
Sorry, could you repeat that last bit?
I was just wondering if there's a scenario where you could ever see yourself starting to have the negative interest rates conversation.
This is an important question, guys.
Yeah, well, sorry. No on the negative interest rate conversation. I don't see a scenario for that. I think I've been about as clear as I can be on that. If anyone just
wow, that's hawkish.
Whatever you want to take that off the table for me, okay? I'm not trying to be clever in the way I'm answering that question. But on house prices, Ben.
On house prices, we have in the central forecast, and if there were fans around this, and we published a chart, it would probably be wide, at least as wide as any other fan we have. I think we have predict in that central forecast a small decline in house prices over the next year, and then they start to pick up again in line with average incomes after that.
Governor, Richard Barley from Wall Street Journal. If we're at the point where interest rates, a move lower in interest rates has to be offset for the banking system by the term funding and some of the tweaks to regulatory measures, what are the implications for the wider financial system, particularly of very persistent low rates? You talk about this move into riskier assets. We've already had 7 years of people moving into riskier assets. Where does this go from here, and what are the wider financial implications for stability?
Yeah, look, I'll step out of the MPC role for a second and speak as a member of the MPC, or the FPC, rather, all of us are. We basically approach financial stability from a perspective of we're in a low-for-long world for a long time, because when you think about downside risk, that's the downside risk. So the stress tests that we favor are those which are sort of bear flattening type of curves. We look at the implications of very low interest rates for the insurance companies and how that flows back through for the pension sector, for other asset classes, and how they manage that. At this stage, we understand these risks. We don't see these risks, these costs. We see these risks and costs as being absolutely dominated by the benefits of providing the stimulus. First point. Second is to go back to something I said earlier, which we've stressed a number of times at these press conferences, is the reason we have low interest rates is not because central banks are choosing to have low interest rates. There are much bigger forces which are driving this. And so the question is whether we're blind to that and therefore we don't provide the right amount of stimulus for the underlying economy, or we take it into account. It does make our job harder as a whole, because we do have to absolutely worry about these channels. We do have to take adjustments. That's part of the reason why you see such an active FPC and an active international regulatory agenda, of which this institution is very much a part of.
Hi, Scott Hamilton from Bloomberg News. Since the Brexit vote, we've seen a lot of turmoil on the other side of London, a lot of political turmoil. Would you like to take this opportunity to reassure investors and markets about your commitment to seeing the UK economy through this choppy waters? And does that mean staying on till 2021?
Okay. Didn't quite know where you were going with how I could reassure investors. I'm glad that's the way you ended up on it.
About stability at the
yes, yeah. No, look, I'll say two things. First is that it's an absolute privilege to have this this role, and it's a tremendous responsibility, and we have been, it's not going to surprise you, we have been flat out since the run-up to the vote through to this discussion and beyond this discussion. And I can candidly say I have not had a moment to sit back and reflect on an issue that I said I wouldn't come back to until the end of the year. So I appreciate the question, but I don't have an update because it's a privilege to have the job, and we've been doing the job. Thanks.
Hi, my name is Matthijs Schiffers from the Dutch Financial Times. You said you're not a fan of negative interest rates, but what are your feelings about helicopter money?
Well, that's
important question. Important question.
I'm trying to think of the way to express it. No, I don't see I don't see the merit in the strategy. I don't. Look, let me answer it this way, which is that we have a range of tools. We still have scope under all the tools we announced today. There are other things we could do if necessary. It might not be necessary that we have to provide additional stimulus. It depends on how the economy unfolds and how the trade-off evolves. But there's not a need, and I can't conceive of the situation in which there would be a need to have such flights of fancy here in the UK.
Unemployment data in 2 minutes from the US.
Helen Thomas. Governor, you mentioned in a couple of places here that purchases of corporate bonds could actually have a greater effect in the economy today than purchases of gilts. Mm-hmm. Given that you've been very clear that you don't see other easing measures going much further, what is the scope to expand that 10 billion given the overall size of that market?
Okay, two things. First, I would say that, again, we see scope for all of the measures we announced today to go further. But secondly, to answer specifically on corporates, I'm going to ask Manoush to answer that, but also maybe give a bit of a context, not just about going further, but how we're going to run the program.
Sure. We estimate that the sort of universe of firms that would be eligible for our corporate bond purchases would be about 150 firms, and it's roughly a market of about 150 billion. So we think that purchasing 10 billion in that context is quite feasible, and there are various things we could do to expand the universe of purchases. But the initial focus will be on purchasing conventional senior unsubordinated debt. We will look at only debt which is corporate bonds which are rated investment grade by at least one of the major agencies, but we will also do our own assessment of creditworthiness. We'll look at minimum amounts of about 100 million, and we will operate initially only in the secondary market, so bonds that have been in the market for at least a month. So that's where we're going to start, but as the Governor said, there are various ways we could expand that if the MPC decided that it wanted further stimulus.
Last question.
Hi, Sam Nussi from Nikkei. Given this...
Largely as expected, unemployment claims.
With the rest of the world, and also how long it would take. Some people are suggesting 2 or 3 years, some people are suggesting 10 years. How does the bank go about making forecasts in that situation? And do you have a central case that you're using? Thanks.
Right. We haven't picked any particular model for the new relationship with the EU. What we have assumed is that there will be a period at some point beyond the forecast horizon where the degree of openness in the UK economy will be somewhat lower than it is today. And just to follow that logic through, virtually any new model of the EU relationship has some reduction in the degree of openness compared to being a full member of the European Union. That's understandable. But we haven't picked a specific one. So if you just look on average in terms of probabilities, you come up with an adjustment. It's clearly the strategy of the UK government to more than compensate for that reduced openness with the EU with greater openness with the rest of the world. There's a question in terms of the exact timing of the compensation given the time to negotiate trade deals. And so the basic assumption, which is relevant to the model or to the forecast, is some reduction in openness beyond the forecast horizon, which then affects some of the investment decisions today. But of course, what's some of the big drivers? The big drivers of this forecast are uncertainty about what we've just discussed, of course, which has an impact. The adjustments that are going on and expected in property markets, which have an impact on demand, and some marginal increase in the cost of capital. All of that flows through to the outcome. So that's where we end up. We don't pick a model, and it wouldn't be credible if we did.
Thank you very much, everyone. That's all the time. Thank you.
All right, guys, there we have it. Actually, you know, in terms of what he could have done then and what he did do, he definitely didn't smash the cable. You know, the few things to take away from that. He doesn't like negative rates. He doesn't like helicopter money. Basically put his stamp saying that's not going to happen. He did say the door is open to expand QE. He did say the door is open to cut rates down to 0.1. That's effectively what he was saying there. And he did say that, you know, there is options to increase the corporate bond purchase as well. Now, the Bank of England have put in measures so that this extra stimulus and bank rate cut should be pushed through to the consumers. And they've actually going to try and force the amount of lending that the banks do. So that's interesting, and we'll see how that develops over time. But in relation to the pound, he said that he's not focused on the pound, all right, which is very interesting. And, you know, that's another hawkish comment. So he had an opportunity to really smash it. He didn't take that opportunity, and his sort of benign attitude towards the pound means that, you know, any sort of recovery here, any sort of resumption of looking at the weakness of the US dollar rather than the pound could easily allow this pound to rally. What's going on though with the US dollar, it has a little bit of a kickback in the last couple of days. So the kickback in the US dollar, especially against the euro, you know, that's making some effect on some of the pairs. We'll see if the euro can resume its uptrend. If that can happen, then pound's going to be well supported as well. Obviously, everything though is hinged upon that NFP number tomorrow. So we've gone now from looking at the pound to looking at the US dollar. All right, so straight back to the US dollar. The pound now, everyone knows what's happened. Continued selling on the back of that BOE is unlikely, but there could still be some more pound selling in the next 24 hours if the US dollar is to gain some strength. Keep an eye on stock markets as well. They've been a little bit volatile here post that announcement. The initial rally was reversed, and that's a little concerning. Certainly, though, that does help the euro, so, you know, keep an eye on that. Oil's doing a little bit better as well in the last 48 hours. So you are seeing some stabilization there. Canadian dollar is the main benefit from that. Canadian dollar was one of the weakest pairs out there, weakest currencies, and now it's starting to get some strength. Aussie and Kiwi are doing their thing, continuing to be strong. The Kiwi dollar, though, is definitely going to come under pressure probably Monday, ahead of its meeting there on Thursday morning. So let's not be long the Kiwi, let's be long the Aussie or the CAD. But obviously the CAD's keep an eye on oil. So the cleanest of the options is Aussie. But buying the pound here definitely makes sense to me. Position, you know, in another world, if they did what they did today, then the pound would be down 400 or 500 points. So this is actually relatively bullish price action. Not as bullish as the price action we saw from the RBA when they cut and then the market ended up higher on the day. But definitely wouldn't surprise me as well to see the pound bounce substantially in the coming days. Yeah, and it's just there's nothing more to look forward to for the next couple of meetings, most likely, and there's just better return here buying the pound against the US dollar than buying the euro or buying some of the other pairs. So if you have a weak US dollar outlook, one of the pairs you're looking at here is the pound. Pound yen is a bit more related to the stock market and the dollar yen, so probably stay away from that. Pound Kiwi was talked about in the room. A trader placed that trade idea. Now, time-wise, in the next 5 days, the chance for that to rally is very high. So I'm looking at that pair in particular. That's not a bad little way to play a pound recovery. On the top side, we're looking first at that 133.50, and then we're looking at 135. Past of 135, we're opening 138. Now that the Bank of England's done its thing, I think the short squeeze makes more sense to me than the 125. Look, a lot of analysts and banks put out 130, 125 on the pound. So it's definitely not consensus view. This is a bit of a contrarian type trade. But my whole view is that the market's too short the pound still, and that the US dollar weakness is going to be extremely strong in the next coming couple of weeks. Now, NFP tomorrow, we'll talk about that. We are going to be live streaming it. We're probably going to start the stream half an hour before, and we're going to go over game plans for it. All right, we're going to go over game plans as to how we're going to set up, what pairs we're going to watch, what levels we're going to watch, and different scenarios based upon the numbers, and different scenarios based upon each number and the price action that generates. So a strong number but limited price action gives you another trade. A strong number with sharp selling, gives another trade. A weak number or as expected number, we'll go through the different options, not just of the number, but the different options for what you expect to see on that, and if you don't see that, what that means in terms of, say, US dollar strength, and then how you can play it. It's very whippy non-farm payrolls, so it is important that you do prepare your trade ideas in advance. You don't trade beforehand, you trade after. That's the general way I like to trade it. It's extremely dangerous, but it is also quite rewarding. And so it's another day where we will be trading quarter lots rather than full size trades, about a quarter the size of your normal trade. All right, is there any questions there before we end the stream tonight? Otherwise, I will be here tomorrow for you. We're going to review, obviously, tomorrow as well, how all the markets respond today and how the pound reacts. Short term here, I'm looking for 132. Then I might just square up on my long pounds, looking to buy dips after that, or looking at some of the crosses. Euro pound short, pound Kiwi long, pound yen long as well, if the stock market's rally. If the stock markets go down, that's something that's going to change the way we play it. Okay, but we'll talk about that tomorrow. Alright guys, thanks for tuning in. If you want me to look at a specific chart tomorrow, please just send me a PM inside the Forex Signals chat room. That's the best way to ask me questions, yeah. Thanks guys.